CPI inflation is now expected to peak at around 5.6% in the third quarter of 2019. The forecast for core inflation is 4.3% in 2018, 5.3% in 2019, and 5.5% in 2020. These inflation projections are based on an interest rate path generated by the SABC quarterly projection model. Following persistent increases in oil prices since February, the assumptions for Brent crude oil in the QPM were revised upwards by $3 per barrel to $73 for 2019 and 2020. Administered prices, including fuel, electricity, and water tariffs, are expected to increase at rates above the upper end of the inflation target range. Inflation expectations of market analysts in the November Reuters Econometer survey are lower at 4.7% in 2018, rising to 5.5% in 2019, and remaining unchanged at 5.3% in 2020. Expectations implicit in the break-even inflation rate remain sensitive to exchange rate movements. While 5-year break-even rates remain within the inflation target range, the longer-term break-even rates remain above 6%. The global economic outlook is expected to remain broadly favorable over the short term. However, medium-term risks are tilted to the downside due to less synchronized global growth. This is amplified by elevated policy uncertainty emanating from escalating trade tensions, tightening global financial conditions, and rising geopolitical risks. The global inflation trajectory remains on a moderate upward path as key advanced economies continue to grow above their potential. Since the September MPC, the rand has appreciated by 3.8% against the US dollar, by 6.6% against the euro, and by 5.2% on a trade-weighted basis. The implied starting point for the rand is 14 rands 50 against the US dollar, compared with 14 rands 20 at the time of the previous meeting. At these levels, the QPM assesses the rand to still be undervalued. Tighter global financial conditions, financial market volatility, and the change in investor sentiment towards emerging markets remain key external risks to the rand. Over the medium term, it is likely that the rand, along with other emerging market currencies, will remain volatile. However, the pace of monetary policy normalization in the advanced economies continue to be gradual. Policy tightening by the US Fed is expected to follow a measured path in the absence of significant inflation or growth surprises, while the European Central Bank is expected to start a rate hiking cycle in late 2019. This means that monetary policies in some advanced economies will likely be tightening throughout the forecast period. The domestic growth outlook remains challenging. Recent monthly data on economic performance in key sectors suggests a more moderate recovery in growth in the third quarter than expected in September. The SARB now forecasts growth in 2018 to average 0.6%, down from 0.7% in September. The forecast for 2019 and 2020 is unchanged at 1.9% and 2% respectively. At these growth rates, the negative output gap is wider than at the time of the previous MPC meeting. The output gap will narrow but will not close by the end of 2020 as previously expected. The SABC composite leading business cycle indicator has been trending lower since February, reflecting the extent of weakness in the economy. The year-on-year increase in September was the largest since July 2016 and mainly reflected a significant decline in the number of building plans approved and a reduction in job advertisement space. The RMB BER Business Confidence Index remains significantly below the neutral level of 50 index points, broadly aligned with weakness in growth-fixed capital formation. Efforts by the government to encourage private sector investment could support longer-term growth. With the FNB BER Consumer Confidence Index remaining high, household consumption expenditure has been constrained by tax changes, weak employment growth, as well as low growth in credit extension to households. Over the forecast period, consumption expenditure growth is expected to remain below 2% in 2018 and 2019 and to reach 2.3% in 2020 on the back of increases in real wages and household disposable incomes. The MPC assesses the risks to the growth forecasts to be moderately on the downside. As previously highlighted, the committee remains of the view that current challenges facing the economy are primarily structural in nature and cannot be resolved by monetary policy alone. Prudent macroeconomic policies are essential to ensuring that growth is sustainable and that the economy is more resilient to shocks. These should be complemented by implementation of credible structural policy initiatives that make a marked impact on the cost structure of the economy, potential output, and employment. The MPC noted the rising inflation trajectory, which, while remaining within the target range, continues to deviate from the midpoint of the target range. The MPC continues to assess the risks to the longer-term inflation outlook to be on the upside. These risks include tighter global financial conditions, a weaker exchange rate, higher wage growth, international oil prices, and rising electricity and water tariffs. However, demand pressures are still not assessed to pose a significant risk to the inflation outlook. The approach of the MPC is to look through the first round effects and focus on the possible second round effects of supply side shocks. However, shocks of a persistent nature, such as extended periods of currency depreciation, elevated oil prices, and multi-year electricity price increases make it difficult to disentangle these first and second round effects. The MPC had to decide whether to act now or later. Given the relative stability in the underlying core inflation measures, delaying the adjustment could give the MPC room to reassess these unfolding developments in subsequent meetings. However, delaying the adjustment could cause inflation expectations to become entrenched at higher levels and thus contribute to second round effects which could require an even stronger monetary policy response in the future. Against this backdrop, the MPC has decided to increase the repurchase rate by 25 basis points to 6.75% per year, effective from the 23rd of November 2018. 3 members preferred an increase and 3 members preferred an unchanged stance. The committee continues to assess the stance of monetary policy to be accommodative. Monetary policy actions will continue to focus on anchoring inflation expectations near the midterm point of the inflation target range in the interest of balanced and sustainable growth. As previously indicated, any future adjustments will be data dependent. The implied path of policy rates generated by the quarterly projection model is for 4 rate hikes of 25 basis points, reaching 7.5% by the end of 2020. The forecasted endogenous interest rate path is built into our growth and inflation outlook. As emphasized previously, the implied path remains a broad policy guide which can and does change in either direction between meetings in response to new developments and changing risks. That concludes our statement. And at this stage, as we would like to invite all members of the media to pose questions. And as usual, please identify yourself and the name of the media house that you represent, and the panelists here will deal with your questions. This is a first. Yes, sir.
Hi, Alex Winning from Reuters News Agency. 2 clarifications. Since the last meeting, you had an MPC member who departed. Is it yet clear, have you taken a decision when you might add another member, when that might be, if it will happen? And the second question is about the QPM, the changes to the QPM that were announced earlier this year. Just so I understand correctly, is the QPM purely a forecast model, or does it aim to achieve any monetary policy outcomes? And as a follow-up to that question, with the changes that were made to the model, are they aimed at anchoring inflation closer to the midpoint, or is it, again, purely for forecasting purposes? Thank you.
Is that the only person interested in questions? Okay. Okay, shall we close the questions then? And the member of the MPC didn't depart. He retired. He retired. And we are searching both internally and externally to find a 7th member. Previously, it did take us a long time to arrive at the decision. It is quite a process in terms of the skills and experience that we are looking for. We would prefer to have that sooner rather than later. With regard to the QPM, yes, the QPM is a forecasting model. It does a forecast. Remember, it is a four-gap model, which then in it endogenously derives an interest rate path. It is that path you can say, yes, we are sitting here. There are 6 MPC members. You can see that path generated by the QPM as the views of a 7th MPC member. that MPC member must debate with all the others before we could arrive at a decision. So all the other MPC members make their inputs, and this 7th member called the QPM also makes an input, and the views of that member are always put here in public so that you can know what that member actually thinks. A model can achieve policy outcomes. It could tell you, if you take particular steps, what the policy outcome would actually be. So the outlook that we have presented today in terms of growth and in terms of the inflation is taking account of what the QPM says. So if you did all the things, if you took the path that the QPM says you must take, that would have been the outcome that you have. Would the QPM enable us to anchor inflation expectations closer to the midpoint? Well, the QPM itself is actually in it, with the way in which QPMs work. You can't put 3 to 6 into the QPM. It would want a point. So it was easier to take the midpoint. So it tells you that if you do all of these things, this is what the inflation would actually look like. It is the preference of the MPC, not of the QPM, to get inflation expectations anchored closer to the midpoint, anchored at 4.5%. It is, we believe, a level that will give the MPC flexibility that should we experience a shock in either that impacts inflation in either direction, we are able, as a flexible inflation targeter, to continue to work within that target range that we have agreed with the government. Lucanio.
Can I first ask an obvious question? Since it was 3-3-all, so I can assume you had the deciding vote. And secondly,
is that the only question?
No, so I wanted to ask you. So, as looking from the outside, should we now consider 4.5% as basically the unofficial target, or is it a target that is still 3 to 6? Because based on what the numbers you've given here, it seems that the outlook has actually improved since the last meeting.
Alex?
Perhaps I've missed it in here, but do you have a forecast for third quarter growth? You said that the recent economic data was less favorable than you'd expected in September, but do you expect growth in the third quarter? At what level? Thank you.
Welcome, ma'am.
Thank you, Governor. It's Pranesh Naidu from Bloomberg. Can you please give us an update on what's going on with plans to nationalize the central bank?
Okay, we didn't discuss that in the MPC, but we will deal with it at the end. Any others? Anybody on?
No media questions online, Governor. It's just analysts.
It's just analysts.
Yes.
Okay, let me deal with the media, and then we will come to the analysts just now. Lucanio, if you read the statement, you asked whether did I have the casting vote. The statement says that 3 members preferred, didn't say voted for, preferred a hold, and 3 members preferred a hike. And then what then happens is that we close the room and we debate vigorously until a decision is taken. And in the end, a decision that was taken was that let us go with the 25 basis point hike. Thank you. And the 4.5%, should it be an unofficial target? The target is 3 to 6. All that we are saying is to manage the risks to the inflation, you must be at the midpoint, because if you are at the midpoint, should you experience a shock, you don't have to react in a knee-jerk manner because you have got flexibility within the target. I know that in your earlier days when you used to cover the bond market, the inflation targeting framework used to have something called an escape clause. it didn't help to anchor inflation expectations, because it looked like every time inflation was outside of the target, somebody just pressed escape, and then we do not have to worry about inflation, and it was not helping us. And that is why it was replaced with an explanation clause, which then said, at every meeting, the Reserve Bank must explain why inflation might be within the target or might not be within the target, and what the risks are to that. And that had proved to be more useful from a policy perspective to bring down the inflation expectations over time. Alex, the focus for the third quarter was something we decided not to venture into. We were interested in the sign, and the views are that the sign will be positive. How much positive, we do not know at this stage. We continue to watch the high-frequency indicators. That might be telling us something. At the moment, they have told us the direction, but they have not told us what the actual figure would actually be. Okay, shall we go to the analysts?
Andrea Macia from Morgan Stanley. Thank you for the clarity of the message in recent months. Can you perhaps share the general timing of the repo rate increases in the QPM? And Peter Montalto, can you discuss more this trade-off between waiting to hike versus moving now? What did QPM tell you about this versus what the MPC's views on the issue? And that might be different. Were credibility issues around the model and previous MPC statements a factor?
Is that all from the analysts?
That's all for now.
Distinguished panel. Mr. Kasim, Dr. Kasim, this seventh member who can't talk, any ideas of the schedule of at which the 25 basis points should actually be taking place? And Minal, we want to talk with on the one hand and on the other hand, now or later.
Thank you very much, Governor. Well, if you compare it to the September meeting, the repo rate path was something like 6.6 for 2018, 6.7 for 2018, 7.2 for 2019, and 7.7 by the end of 2020. And that is kind of, in this meeting, was simply, we moved from 6.7 to 6.6, and we moved from 7.2 to 7.1, and from 7.7 to 7.5. So it's kind of, more or less corresponding to the previous meeting, but just at a slightly lower rate.
Peter, thanks for the question. And I think as we tried to sort of put it in our statement, when you get to these turning points for policy, it becomes very, very finely balanced in terms of the various factors that could influence it this way or that way. We have indicated both at our last meeting, at this meeting, based on the preferences that the Governor was just talking about. You can see that this decision was arrived at after a fairly robust debate. So when you get to these very fine lines, you can, with a very high level of conviction, argue that we maybe should have waited this time around, but you can similarly argue with strong conviction that this was the time to move. So it becomes a risk management exercise, and as was indicated, after extensive deliberations, we then came to the conclusion that it would be prudent to move at this meeting. But the arguments for and against were equally strong, as the preferences show.
Okay, I will go to the last non-MPC question, and then we'll close. Francois, the MPC didn't discuss this nationalization thing, but...
Thank you. There isn't really significant updates on the issue. As you would recall, the ruling party took a particular resolution at their policy and elective conference at the end of last year. What is notable is that the newly installed Minister of Finance, of course, in MTBPS state.
The South African Reserve Bank surprising somewhat by increasing the repo rate and the prime lending rate there by 0.25 percentage points or 25 basis points there. It is one that we will unpack very shortly. Of course, we are awaiting the president as well to give his announcement of that cabinet reshuffle. We'll get back with this right after this. Do stay tuned.